What's the real message behind Moodys' downgrade of U.S. credit rating? Explained. Moodys has downgraded the United States credit rating amid concerns about nation's fiscal health and rising national debt. The global financial firm said the downgrade reflects the increase over more than a decade in government debt and interest payment ratios to levels that are significantly higher than similarly rated sovereigns. Successive U.S. administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits and growing interest costs, the firm explained, as quoted by Fox Business. We do not believe that material multi-year reductions in mandatory spending and deficits will result from current fiscal proposals under consideration. Let us understand why credit ratings are given to a country or a company, what will be the implications of the downgrade on U.S. economy and others. What are credit ratings? A credit rating is an assessment of a country or corporate whether it will be able to repay its debt on time and in full. When ratings agencies downgrade the credit rating of a country or company, it can serve as a signal to the market that the debt is riskier, which can result in higher interest rates to compensate for the additional risk. As per Fox Business. In the case of the federal government, it means more spending on interest costs incurred from the national debt. A high credit rating means the country or company is likely to repay its debts. A low rating suggests a higher risk of default. Better ratings usually mean lower interest rates because lenders see less risk. Worse ratings mean higher borrowing costs. The big three credit rating agencies are Moodys, S&P Global, and Fitch. Each rating agency has its own scale, but hey race, what Moodys rating version is? AAA rating means highest quality and lowest risk, while AA1, AA2, AA3 means very strong capacity to repay. A1, A2, A3 is upper medium grade, which means strong but more susceptible to change. BAA1, BAA2, BAA3 is in the lower medium category, while BA1 and below is speculative and at higher risk of default. C means missed default already. Why U.S. credit rating has been downgraded? Moodys downgraded U.S. credit rating from AAA to AA1 on May 16. During Monday's trading session, the yield on the benchmark 10-year Treasury bond peaked at 4.56 before declining to about 4.45. Yields on the 10-year started the year above 4.5, were around 4.3 for much of March and April before rising this month. The 10-year is used as a benchmark for other interest rates, including mortgages and corporate bond yields. The downgrade has come as Republicans in Congress seek to approve a sweeping package of tax cuts aimed at boosting economic growth that at the same time could add trillions to the $36 trillion U.S. public debt pile, exacerbating concerns over the U.S. fiscal trajectory. It also follows a détente in the trade war sparked by President Donald Trump's imposition of tariffs on U.S. trade partners. While tariffs are largely seen as being a drag for the economy, a recent trade breakthrough with China had sparked market optimism that their impact would be more muted than feared. Rising national debt. The U.S. national debt has surged to over $36 trillion, up from $28 trillion in 2019. This increase is attributed to sustained federal spending and reduced revenues from tax cuts. Moodys projects that extending the 2017 Tax Cuts and Jobs Act could add approximately $4 trillion to the debt over the next decade. In March, Moodys warned that the growth of the national debt was becoming unsustainable and put the U.S. at elevated risk of a downgrade. Fiscal strength deteriorating. Successive administrations and Congress have failed to implement measures to reverse the trend of large annual fiscal deficits. This ongoing imbalance between spending and revenue generation raises concerns about the government's fiscal discipline. In August 2023, when Fitch Ratings downgraded the U.S. from AAA to AA, it said large federal deficits and national debt, as well as looming fiscal challenges posed by rising spending on Social Security and Medicare, contributed to the move. Increasing interest rates. As interest rates rise, the cost of servicing the national debt escalates. Moodys estimates that interest payments could consume up to 30% of federal revenue by 2035, up from 9% currently. What does the downgrade mean for U.S. economy? Higher borrowing costs. The downgrade led to increased yields on U.S. Treasury bonds, with the 10-year yield rising above 4.5 and the 3-year yield surpassing 5. This translates to higher borrowing costs for the government and consumers, affecting mortgage rates and other loans. Bond prices and yields move inversely. Thus, Americans struggling to keep up with high interest charges won't get much relief anytime soon amid Moodys downgrade. Swipe left for next video. Market volatility. The bond market reacted sensitively to the downgrade, with fluctuations in Treasury yields. While the stock market showed resilience, the long-term effects on investor confidence remain to be seen. Some loans could see more direct impacts because their rates are tied to bond prices. Global economic impact. As the U.S. dollar serves as a global reserve currency, concerns about U.S. fiscal health could have broader implications for international markets and economic stability. Latest blogs.